U.S. natural gas futures were trading near the $6.80 mark, moving away from an almost two-month peak of around $8 hit on November 23, on expectations of lower demand and record production levels. Recent forecasts are pointing to milder weather over the next 2 weeks, while average gas output in the U.S. lower 48 states has risen to a record 99.6 billion cubic feet per day in November, up from 99.4 billion cubic feet per day in October. Yesterday, the market closed lower for the fourth session out of 6 as mixed weather forecasts continued to weigh on investor sentiment. Sellers were also in control as Freeport LNG continued to offer no insight into when the processing plant would restart operations. Furthermore, the U.S. House of Representatives voted to take measures to avert a national railroad strike. This news spooked a few of the weaker speculators, who had bet the strike would lead to increased demand, into liquidating their long positions. The U.S. Energy Information Administration reported a larger than normal 81 billion cubic feet per day withdrawal from natural gas storage inventories for the week ending November 25. Total working gas in storage as of November 25 stood at 3,483 billion cubic feet per day, which is 89 billion cubic feet below the similar week last year and 86 billion cubic feet below the 5-year average. Next week's EIA report will also be factoring more comfortable conditions over most of the U.S. this past week for a smaller than normal draw in the 10 to 20 billion cubic feet range. Today's report, which covers the week ending November 25, is not expected to have too much of an impact on prices. Most traders are focused on the weather at this time of the year. Also catching the eye of traders are two potentially bullish events: a potential railway strike and the restart of the Freeport LNG production. Both have the capability of spiking prices sharply higher.